Okay, good morning, everyone from New York City. This is Adam Ring from FFI, Online Executive Education. I am joined today by my colleague, Shelly Lombard. Hey, Shelly, how are you?
Hello, everyone.
Shelly, thanks for being here today. For those of you, if you want to make sure you're in the right place, this is going to be a 1 hour webinar, introduction to distressed investing. And we appreciate everyone for coming today. Just a few remarks. I know we have some people from different backgrounds here. And I know some of you, just as a background in FFI, some of you may be enrolled in or alumni of some of our programs. Some of you may be considering some of our programs. And just as a quick overview, at FFI, we partner with the world's top business schools to help them run online-based certificate programs in finance. We have 4 programs starting next month, 2 with Columbia Business School, one of which is called ICCF at Columbia Business School, which is a 18-week program focused on corporate finance. We also have a program with the Wharton School of Business, Asset Management at Wharton Online, also starting next month. We have a program with UNC Kenan-Flagler called Capital Markets at UNC. And in addition, we have one starting in April 1st, which is our newest program called M&A at Columbia Business School, which will be an 8-week program. So for more information on that, I know we're not here to talk about the programs. We're here to hear from Shelly on this interesting topic, but please take a look at First Finance Institute, the site, if you need any additional information on those programs, and our team is happy to help. So let's kick it over to Shelly. Some of you who've gone through some of our programs, you may know that Shelly is been a teaching assistant for a variety of our programs with Columbia, with Wharton, and UNC. But Shelly, before you go through your prepared remarks, would you mind just giving a brief background to everyone about your experience in the markets?
Well, sure. So I'm going to cram a lot of information into an hour, and I'd like to leave some time for questions. So I won't go into a lot of detail about my background. Here's a bio here. But as you can see from the bio, I've spent about 30 years, ever since I graduated from Columbia with my MBA in finance. I've worked with highly leveraged companies, high yield companies, LBOs, etc. And then most of that time working with highly leveraged companies, I spent working with distressed companies. And when I say working with, I either worked at a hedge fund or a prop fund, and we invested in high yield and distressed debt and beaten up equities, or I was on the sell side and I was writing research reports. I was covering distressed companies. So almost all of my career has been in distressed. The little bit of time before I got into distress was spent with LBOs and just highly leveraged companies. So credit is basically my background. And I think of distressed investing as kind of the ultimate credit product, because you're really dealing with companies that may not survive. So it goes beyond just, credit ratios like interest coverage, et cetera. You're really dealing deeply with valuation and, where I am in the capital structure and stuff like that. I fell in love with doing distressed. My first distressed investment, I think I was working for a company, kind of a prop fund, proprietary trading fund, and we bought some bonds in a distressed name for like 30 cents on the dollar, and then we kind of worked it out. We had advisors, we negotiated, we worked with the bankruptcy court on the value of the company, and I think we ended up we're getting a return of like 60 cents. So basically we doubled our money in about a year. So I fell in love with it from there, not just the high risk, high reward aspect of it, but also the thought process that goes into figuring out, is this company going to survive? How can I make money on it, et cetera. So I really love distressed investing. Adam, if you're ready for me to dive in, I'll go on and dive in.
That sounds great, Shelly.
Okay.
Thank you.
All right. So distressed investing obviously can't be taught in an hour. In another life, I teach a 4-part class and I'm cramming information into that. So what I'm going to present today is really just an overview of how you would approach a distressed investment, how you would think about whether you wanted to make an investment in a distressed situation. I'm going to talk today about distressed bonds and what I call beaten up or deep value equities. Now, retail investors like you and I on an individual basis don't usually buy bonds, distressed bonds or healthy bonds, just because, a typical bond, the smallest size you can typically buy is $1 million. So every now and then, or sometimes you can buy what's called odd lots. So it's maybe $50,000 of worth of bonds. But even if they're trading at 50 cents on the dollar, that's $25,000. So that's a lot for a retail or individual investor. But individual investors can do kind of beaten up equities. Now, two big caveats to that is that equity holders rarely recover anything in bankruptcy. I think I've been involved in, hundreds, if not 1,000 bankruptcies in my 30-year career. And I don't think I can think of a situation where a company went into bankruptcy and there was value left for the equity holders. So what you're really trying to do when you're looking at a beaten up equity, and I'm going to walk through the valuation process, is think about whether this company can survive. If it goes into bankruptcy, bondholders can or something, but equity holders typically don't. So really, when I'm talking about beaten up equities, I'm talking about situations maybe like General Electric, where the bonds have fallen from, where the stock has fallen from something in the 30s to single digits, and that kind of thing. And you say, okay, I think General Electric's going to survive, so I'm going to get into the equity. So those are the kinds of equity situations that I'm talking. You think the company's going to file, then if you buy in the equity, you stay far away from it. Just because, typically in bankruptcy, equity holders don't recover anything. The other caveat is we're not talking about penny stocks here. So penny stocks are stocks that are issued at $1 or, a few cents. That's the issue price. And they don't trade on an exchange. Trade by appointment. So they're not liquid, not what we're talking about here at all. We're talking again about General Electric or, Tesla. You don't think of Tesla as a beaten up stock because it's $300 a share, but those kind of things where the stock is under significant pressure, not stock that was issued at pennies on a dollar out of the gate. So let's jump right into it. So if the bonds are trading at 60 cents on the dollar or the stock is trading at $2 a share, obviously something's wrong with the business. And so in order for it to be a good investment for you, those bonds need to be worth 85 cents or that stock needs to be worth $5 in order for you to make money on it. So in developing an investment thesis, and that's what we're trying to do here, there are a couple of steps to go through. The key is understanding what went wrong and can it be fixed? Because businesses are typically worth more alive than dead, especially, as I said, if it's equity that you're looking at, you don't want the company to file. So you want to have something where the company can be fixed. So you have to understand what went wrong in order to understand, can it be fixed? Second, does management have enough time to fix it? Because again, you don't want the company to go under or file Chapter 11 before it's fixed, especially if you're an equity holder. If you're a bond holder, you might recover something when the bankruptcy is over, but what you won't get while the company is in bankruptcy, the company doesn't pay you interest. Then we're going to talk briefly about what the company's bonds and equity is worth, how you get at that, and then lastly, what price you should pay for the stock or the bonds. So let's jump in and get started. So in developing an investment thesis, I usually do a couple of things. I start by reading the 10K and the 10Q, focusing on the business description and the management discussion and analysis, which talks about the competition, which talks about the customers, etc. I listen to the earnings call. For retail investors like, I am when I invest for myself, you can get the earnings call. You can listen to it live, either on the company's website, or there's usually a replay available. Or you can go to a site called Seeking Alpha, and they will usually have a transcript of what transpired on the earnings call. So you want to hear management spin their story, why earnings are down, why revenue's down, etc. Analyst reports, something that you have access to if you're an institutional investor, Morgan Stanley, Goldman Sachs, etc. If you're not, if you're a retail investor like I am when I invest for myself, I go to places like Seeking Alpha. You got to kind of take those with a grain of salt. I've seen them do things like, because it's just, I won't say random people, but, they're not Morgan Stanley or Goldman Sachs analysts. So I've seen them do things like, talk about how CapEx is flowing through the income statement. And I'm like, that's not right. So you got to kind of take it with a grain of salt, but it is a data point to think about. And then I review the financial statements, the 10K and the 10Q, where's revenue going, where are costs going, etc. What went wrong with the company can usually be broken down into a couple of categories. Two categories, really. Either revenue is declining or costs are going up. That's why EBITDA is declining, earnings are declining, and the company's having problems. Now, if it's a revenue issue, it can be either industry-wide or company-specific. If it's industry-wide, it's very often cyclical or secular. So cyclical might be oil and gas, for example. Oil prices have collapsed. They were close to $100 a barrel. They are no longer. So not only are exploration and production companies struggling, but anyone who sells to them, the guys who lease the helicopters that fly out to the offshore rigs and et cetera, a lot of them have gone under. So that's cyclical because at some point we assume that oil prices will come back. A secular industry-wide issue is like what's going on with retailing. So you're seeing Sears possibly go under, JCPenney, but even high-end retailers like Neiman Marcus are vulnerable to what's happening, which is consumers buying more on the internet. So that's a secular issue. We don't expect Sears to ever come back again, or JCPenney, or even some of the high-end retailers that have gone out of business. There's been a secular shift in the industry and it's wiped people out. The other thing that could be happening with revenue is company specific. So that's an issue like Tesla, where they're having operating issues and they can't jam enough vehicles out in order to generate the revenue they need to generate in order for the business to be sustainable. It looks like they're starting to get past that, but it's an operating issue specific to Tesla. On the cost side, same thing. Industry-wide cost issues that are cyclical could be raw materials costs, and we'll talk about that in a minute. A secular cost issue could be something like labor costs, where it's an industry like auto where there was a lot of, everybody had really expensive labor contracts and they started to offshore labor and manufacture other places. And then you have company-specific cost issues as well, tend to be operating issues, maybe even Tesla's an example of that. Every situation doesn't fit into one of these boxes. So for example, PE&G is a utility company in California. They think some of their equipment malfunctioning may have been the root cause of some of the wildfires in California. So they recently filed bankruptcy because they're facing billions of dollars in lawsuits for damage and negligence, et cetera, doesn't fit into any of these boxes. So this is just kind of a framework that the typical distressed company, a way of thinking about what went wrong with this company and to start to think about how it could be fixed. So Goodyear I like to talk about because they had issues both on the revenue and on the cost side. This is an example of an industry-wide cyclical issue. So high oil and gas prices. Oil is a key component in making synthetic rubber. So Goodyear and all its competitors, Michelin, et cetera, were all seeing their costs go up because of oil and gas prices and the impact on synthetic rubber. They also were seeing, obviously, oil prices are linked to gas, and they were also seeing their volume come down, their revenue come down. And why was that? Well, you replace your tires and you buy new tires when your tires wear out. With gas prices being high, and this was kind of early 2000s, consumers weren't driving as many miles. They were carpooling, they were taking public transportation, so unit volume was weak because people were replacing their tires less frequently because they didn't have to. Tesla, we've talked about their problems are pretty, well known. Problems scaling up to, generate more production to basically get revenue up and cover some of the high fixed costs that auto manufacturers have. And then Cumulus Communication is the second largest radio station operator in the U.S. I forget how many stations they have, but it's hundreds and hundreds. Well, now what they're seeing is a secular change. Advertisers have a lot more options to advertise than they used to be. It used to, if you were GM, you might advertise on radio, on television, and maybe newspapers. Now you have mobile, you have a plethora of internet sites, etc. So radio advertising will never be at the level that it used to be, because a secular change has meant advertisers have a lot more options that they're taking advantage of. So let's just talk about Goodyear for a second so we can think about how you would think about what went wrong and can it be fixed. So rubber prices were up. It was industry-wide. So that meant a couple of things. Goodyear and Michelin and everybody else was able to pass on those price increases for rubber because it was industry-wide. There's inelastic demand because you got to have tires. There's nothing that you can substitute a tire for. You can't, do anything. If your tires have worn down, you need to replace your tires. So Goodyear, on the cost side, Goodyear could pass those higher rubber prices on. On the revenue side, what was happening was Goodyear decided to offset the lower volume by getting customers to pay a higher price for the new products that they had that were supposedly safer. So what they were doing was saying, hey, the guy might not, or the family might not replace their tires, once a year or whatever they wear out, but whenever they do come in, maybe it's 18 months or, 14 months instead of 12 months, when they do come in, we're going to sell them the run flat tire. And the run flat tire is more expensive, but what it does is if you're on a lonely, deserted highway with your family and you're driving and you get a flat, the run flat tire allows you to drive another 50 miles to get to the next place where you can get help, get a new tire, etc. So I looked at Goodyear years ago. I was comfortable, given what I knew and what we saw on the last slide, that they could pass on their costs. But what I didn't understand immediately was what they were doing on the revenue side. I didn't get it. The stock dropped down to single digits. It was somewhere between $5 a share and $9 a share. I got religion late and thought, okay, this is kind of interesting. And, the company was right. I ended up being, right, not the only person who thought it was interesting. I think the stock went up to the 20s or something. So let's step back and think about what went wrong and can it be fixed. If it's cyclical, management will usually acknowledge what went wrong. It's industry-wide. Everybody's going through the same thing. They're not embarrassed. The key questions are this: when will it end? So when will oil and gas prices go back down again? And second, in the meantime, can Goodyear offset the impact of lower revenue or higher costs until the cycle turns? And we saw in Goodyear's case, they did. They could, both on the revenue side, offset what was happening with lower volume, and they could offset it on the cost side by passing higher costs along. If it's an operating issue, then what went wrong is not always obvious, and management may not acknowledge it. And the key question to ask is, can this management team fix the problem? So in Tesla's case, that's why there's so much attention on Elon Musk, in addition to the fact that he's very, eclectic and kind of, quirky personality. The question is, can he get this operating problem fixed so Tesla can increase its volume and therefore its cash flow? And then if it's a secular issue, it's not always obvious what went wrong, not like it is with a cyclical issue, and management is often in denial. So the question is not when will it end, but will it end? It may not be a fixable problem. So like in the case of radio and Cumulus, if there's been a change in customer preferences, I don't want to just buy radio anymore. I want to spend advertising dollars on mobile, on the internet, or if there's ability for the customer to substitute something else for your product, then that company may no longer have a reason to exist. And reason to exist is kind of a mantra in distressed investing. You want to invest in companies that have a reason to exist. There's a book that I'll recommend by a Columbia professor, Rita Gunther McGrath, and she talks about, it's called The End of Competitive Advantage, and she talks about the fact that, especially with all the technology advancement these days, that some companies will no longer have a reason to exist. She doesn't use those words. That's what we say in distress, but it's a very helpful way to think about what went wrong with the company and can it be fixed. This is critical, critical, critical. The times that I have made mistakes and lost a bunch of money in the stress market is when I didn't really understand what went wrong with the company and could it be fixed. So when Cumulus, actually one of Cumulus's competitors called iHeartRadio first got into trouble, people thought it was cyclical. Oh, it's just a recession, revenue's down, but really they didn't recognize that there was a secular shift afoot, and that iHeart, which recently filed bankruptcy along with Cumulus, their revenue was never going to be the same. And I remember going to an investing conference and Cumulus's management presented, and they were in denial. They were talking about how it was cheaper to advertise on radio, and it didn't matter because advertising on the TMZ or the latest website or doing mobile advertising was a lot more sexy than advertising on radio, and advertisers had just moved on. So I walked out of that presentation and I called the person who I still do consulting for, a family office that invests money, kind of a proprietary trading effort, and I said, sell your stock, because these guys don't get it. They're in denial. So the question is not, what went wrong, and sometimes that's not always obvious, but also the issue was it probably couldn't be fixed, and Cumulus, it did end up filing bankruptcy. This is critical because, as I said, the times that I've lost money, it's because I made the wrong call on the business. Not necessarily I did the valuation wrong or my IR wrong, but I thought the business could be fixed. I didn't understand what was wrong, and I missed it. Two keys to whether it can be fixed is management execution. As I said, that's why there's so much attention on Elon Musk, and having a reason to exist. So in the book, for instance, what's happening with newspapers, the New York Times and the Wall Street Journal, even though people are getting more of their news online, because they're big papers, they kind of cover the world, they may have a reason to exist, while the Times-Picayune, which is the paper in New Orleans that my mother reads, they may not have a reason to exist. Too local, people are getting their local news from somewhere else. In the book, in McGrath's book, she talks about Netflix. And so I don't know if anybody remembers Blockbuster, but Blockbuster used to rent DVDs. So if you had a snowstorm like the one we have allegedly coming in the New York area now, the line would be long in Blockbuster. Everybody would be renting their DVDs. At one point it was videotapes, renting it so they could watch movies at home while the weather was bad. Well, Blockbuster failed to really understand what was happening with live streaming. Netflix started out renting DVDs by mail, but they got it. And so management wasn't in denial. What they were willing to do, McGrath talks about, is cannibalize their existing business and delve into live streaming. And that became the future. I think Blockbuster had a chance to buy Netflix and they declined. And obviously we know what happened to them. If you're familiar with Blockbuster, they went under, they no longer exist. And obviously Netflix is thriving. They knew live streaming would take business away from their DVD rental business. They would rent your DVDs by mail, but they didn't care because they realized live streaming was the future. So can it be fixed? It comes down to management execution and reason to exist. So second step, does management have enough time to fix it? So these are the reasons companies file bankruptcy. They run out of cash, they can't refinance an upcoming maturity. Sometimes nervous creditors, and this is what happened to Toys R Us, said you got to pay me cash on delivery because I don't know if you're going to be around to pay your bills. Sometimes banks won't waive covenant violations, and that's a whole nother course. But typically it's companies running out of cash or not being able to refinance debt. So back to Tesla, this is their snapshot of their income statement. This is their EBITDA. EBITDA people often think of it as a proxy for cash flow, but it's really not. It's useful for valuation, but it's not sufficient for financial analysis. So these are all the things that EBITDA and ratios that use EBITDA don't capture: taxes, working capital, etc. What you really want to focus on is cash from operations and free cash flow. So here is the top of Tesla's cash flow statement, and you can see how much cash they are generating from their business. And let me just catch up on my slides. Even though their EBITDA looks okay, cash from operations is negative. Now, all of these things back here are necessary to run your business, and they all are reflected in cash from operations, except for CapEx, which we'll talk about in a minute. So cash from operations, and I'll just let me flip through my notes. Companies should be able to generate enough cash from operations to cover what they need to invest to sustain their business. So if cash from operations is negative, or in this case, what people call free cash flow, which is cash from operations less CapEx. If free cash flow is negative, that's a problem. 1 or 2 years, it'll happen. You spend more, you're building a plant, spending a lot, you're spending a lot more than you generated in cash from operations that year. But if it's on a consistent basis, that's a problem. So when I started covering General Motors, they were negative free cash flow. So their automotive operations, forget their finance company, but their automotive operations weren't generating enough cash to cover the heavy CapEx that an automotive business needs to spend to develop new products and basically to stay in business. And if you're not generating it internally, you've either got to use the cash that's on your balance sheet, or you've got to be able to access the capital markets and issue equity or issue debt. And if that access is ever curtailed, you're dead. And that's what happened to General Motors. They were able, as long as they were investment grade, to go and raise bonds and cover their negative free cash flow. And then once they lost their investment grade rating and they started getting downgraded, then they had an issue. Now, that's looking back historically. What we want to do, which is not sufficient for distressed companies, what you want to do is be able to look forward. So for Tesla, for example, and with Tesla, I just presented through 2017. They haven't reported full year 2018 yet. So that was really just for illustration purposes. The concepts are the same. Tesla's, from what I've heard, their recent third quarter production is actually up. So they're starting to generate free cash flow. But as I said, you can't use EBITDA to assess liquidity. But unfortunately, companies don't project free cash flow. So what you care about, historical gives you some clue as to how the business is doing, but what you also want to do to understand whether they're going to run out of cash is to project going forward. Companies don't project for you or give you guidance on free cash flow, but you can come up with it yourself. So what you would do is take projected EBITDA, either the guidance that the company gave or the market consensus or your number, and see if it covers interest expense, capital spending, all these things in the orange block. If it does, that is the equivalent to positive free cash flow. If it doesn't, that's the equivalent of negative free cash flow. So you look back historically to see that's part of the analysis as to what's going wrong here. But if the company's in trouble, you can expect free cash flow to be negative. The key to figuring out whether they're going to run out of cash is going forward. And that's when you look at this. So let's look at the steps that an analyst would take to do that. First of all, they would look at how much cash and borrowing availability the company has. So this is what Tesla had at the end of 2017. Then they would take those EBITDA projections and do this. They take the cash and availability at the start of the period, add in projected EBITDA, what they think EBITDA is going to be. And I just pulled these. Obviously, they've changed a lot. I think this was 6 months ago that I did this. And, whatever the consensus is for Tesla's EBITDA, I don't think the company gives guidance. Whatever the consensus is, it's probably wildly different than what it has here. And then you subtract out all of those things from slide number 20. And what you get is the cash that the company either generated during the period or used during the period, essentially free cash flow. And then you look at how long they can last given this negative free cash flow. So in Tesla's case, EBITDA is projected to increase in 2019, so negative free cash flow will be better. But this gives you a sense of how long these guys have before they run out of cash, have to file bankruptcy or do something else dramatic, and before how much time they have to be able to fix the problem, what people in distress land call their liquidity runway. How much runway do they have? And that's really critical. You have to understand the business, and understand what went wrong and whether it can be fixed, but also management has to have time to fix it. And if they don't have time, they end up filing. And if you're an equity holder, you get wiped out. As a bond holder, you stop collecting interest and you have to sit with basically dead money during the bankruptcy period. The other thing that leads to bankruptcy is not being able to refinance debt that's coming due. So with Tesla at the end of 2017, looking back, and this comes from the debt note in their 10K, this is how much debt was due in 2018, and this is how much debt is due this year. If it's a small amount, like these 2 3/4 convertible notes, they probably just paid that off. They have $4 billion, of cash and liquidity. But in 2019, the numbers start to get bigger. So if you look at these 1 5/8 convertible notes, those convert to equity if the equity is $759 a share. We all know Tesla's stock price is nowhere near that. So what Tesla's going to have to do is either pay off that $566 million from their cash, using their cash, which means it's not available for other things, or they're going to have to refinance that debt with what we call plain vanilla bonds that are not convertible. Trust me, the interest rate on those is not going to be 1 5/8. So what we just saw, the negative free cash flow plus the debt coming due, is the reason why Tesla's debt has been downgraded, and why other people are shorting the stock, because they feel like a lot of Tesla's debt, which is convertible, the stock price is not going to be at the necessary point where the debt can convert to equity. So the company is going to have to either pay it off from cash, which they're rapidly running through, or they're going to have to refinance it at much higher interest rates. So what went wrong? Can it be fixed? And does management have enough time to fix it? In other words, how long can their cash balance and their borrowing availability last the way they're running through cash? How much time do they have? The clock is ticking. And can they refinance debt that's coming due? So if they have bonds that are due in 2022 and their free cash flow is not particularly bad, management has some time to fix whatever their issues are. But if not, you could see a bankruptcy. So what went wrong? Can it be fixed? Does management have enough time to fix it? Now, what are my bonds worth? What are the company's bonds and equity worth? So you start out with a basic EBITDA valuation, DCF, or discounted cash flow, whole separate, presentation. But you start out with what we would call a normal EBITDA range. If it's a cyclical business, normal EBITDA, like oil and gas, could be higher than what it currently is, because we're assuming the cycle's going to change and oil prices are going to rise. If it's secular, like Cumulus, normal EBITDA may be lower than where it actually is right now, because we're assuming that advertisers are going to continue to move away from radio to sexier forms of media, and so EBITDA is going to continue to come down. So what you'd have is a normal EBITDA, and you usually have a range from worst case to best case times a multiple, and you get an enterprise value for the company that you're trying to value, Tesla or Cumulus or Goodyear. I'm not going to go through this in detail, but what multiple do you use? I usually find out who the company's competition is in the competition section of the 10K. That's another reason to read it. And then this is how you would basically come up with what's called a comp set. You would look at where all their competitors are trading as a multiple of their enterprise value. And this is how you do it. It's the market value of equity plus the net debt plus preferred plus non-controlling interest gets you an enterprise value. And then you'd look at, I think I skipped a slide here that I should have included, but that enterprise value divided by EBITDA or divided by sales shows you where that company, those comparable companies, are trading as a multiple of EBITDA or a multiple of sales. So here is one that I did for Cumulus. This was back in 2009. These are all of Cumulus's competitors. That's the market value of the equity, the net debt, that's the enterprise value. And then I looked at EBITDA. Usually I look at it, the enterprise value is a multiple both of revenue and EBIT and EBITDA, but I like to use EBITDA. So you can see that Cumulus's competitors are trading between 7.5, call it an 8.5, close to 9 times EBITDA. Just for point of reference, when I first started covering radio way back in the day, radio companies were trading at 12 to 15 times EBITDA. An EBITDA multiple is a reflection of the market's view of that industry or that company's future prospects. So EBITDA multiples for radio have come way down because the market has realized that radio EBITDA will never generate the kind of cash flow. They will never be as valuable as they used to be because, as I keep saying, advertisers have so many more choices now. So those are the multiples. Just technically, you really should look at things as a multiple of projected EBITDA, future EBITDA. The issue is that when you're looking at your comps, you may not have EBITDA, projected EBITDA for all of your comparable companies. So what that means is you really can't do what's called a forward multiple. You can only do a trailing multiple. Where is the company's enterprise value trading as a multiple of its last 12 months of EBITDA? But sometimes you just work with that, maybe you adjust it, etc. Again, that's a longer presentation. Here is Cumulus, and you can see Cumulus's EBITDA is coming down. It was 363 million in 2013, down to 216 million, close to only $200 million, down about 160 million, which is a lot. Radio is a high fixed cost business. So if you're paying talent to do talk shows or to play music, you're paying Howard Stern or Stephen A. Smith or whoever to do shows, you have to pay them and the staff as well, regardless of whether you have one listener or you have 10 million listeners. So it's a high fixed cost business. Cumulus wasn't even doing well in an election year. Typically for radio, election years are good, and same thing for TV. A lot of ads from the Donald Trumps, the Barack Obamas, the Hillary Clintons of the world. Even in 2016, Cumulus was not doing well. And think about the fact that presidential candidates, let alone the president of the US, is now doing a lot more on social media. So do I really need to buy ads, or can I just tweet out to people who, potentially could vote for me and are thinking about it and who are following me on Twitter? So again, that's a rationale for why we're seeing a secular change, evidence of a secular change in radio, and why it may never come back. So how would we value Cumulus? So maybe you say my downside case is the current EBITDA, around 200 million. That might be aggressive because it could be even lower than that. Cumulus, it may not stabilize at 200. It may drop to 180 or 150. But let's just say for illustration purposes, normal EBITDA is going to be 200 million on the low side. On the upside, I think Cumulus can do something here. I think with better DJs, with better talk show hosts, whatever, that they can get EBITDA back up to 290 million. What's the right multiple? Since Cumulus is one of the bigger radio operators in the market, let's put them on the high side of that 7.5 to 8.5 times and use a multiple of 8.25 to 8.75. And so we have an enterprise value there of kind of 1.7 billion to 2.5 billion. Now, this value is distributed to creditors in a certain order. In bankruptcy, there's an order in which creditors get paid. So for simplicity's sake, let's assume Cumulus gets sold to somebody. They get sold to CBS Radio or somebody, and there's a pile of cash. Who gets paid first? First, it's the dip lenders. So these are the people who give the company a loan while it's in bankruptcy so it can continue to operate. Then you get small claims called admin and priority claims. That's employees they owe money to, their bankruptcy lawyers, etc. Then who gets paid next are the secured creditors, typically the bank debt, who loaned to the company before it went bankrupt. Then any unsecured senior bonds get paid next, any subordinated bonds, then any preferred, and then any equity. If you're a bondholder, you have to read the 10K, maybe have to go to the indenture to figure out, if you're senior, if you're subordinated, who's ahead of you, who's behind you. If you're equity, if you're a stockholder, all the debt's ahead of you, including the preferred. So it's almost easier to analyze because you don't have to read any bond indentures. All the bonds are senior to you, and they get, if the company is sold for $1.7 billion, they all get paid before you get anything. So how would you figure out what these bonds are worth or what this equity is worth? So enterprise value, we've taken everything from the downside case to the upside case. First, the bank debt comes out, the revolver and the term loan. Then you have any residual value goes to the unsecured creditors. This is what's left for the unsecured senior bonds. In the downside case, you can see there was just enough value to pay off the banks. There is not enough value left over to pay off the 275 million of bonds. They're just worth goose egg. However, if EBITDA is higher as it is in the base case or our upside case, those bonds could be worth par, 100 cents on a dollar. So if you could buy them at 60, you got a huge home run. After the senior bonds are paid off, what's left for the subordinated bonds if you sell the company? They get paid next. So in the case of the subordinated bonds, in the downside case where EBITDA is only 200 million, they get zero. In a base case, they're only worth about 20 cents on the dollar. And in an upside case where the company gets its EBITDA back up to 290 million, those subordinated bonds could recover their whole $335 million. What's remaining for the equity? Equity only gets value in the upside case in this particular scenario. If EBITDA can get back to 290 million, if the company hires the right talent, gets more listeners, which drives advertising rates, people get sick of mobile and they decide to come back to radio, and EBITDA goes up to 290 million and the company doesn't file, then your stock, after everybody else is paid off, the stock could be worth $5 a share. Now, in real life, Cumulus had no sub debt. I just did this here so you can illustrate how this would actually work. The stock actually got to 62 cents in Cumulus, I think, maybe even lower. And the company ended up filing bankruptcy. And what typically happens in a bankruptcy is they restructure very conservatively, and the equity got wiped out. What they said was, look, Cumulus is never going to do 290, it's going to do 200. The right multiple is closer to 8 than it is to 9. So really the banks get paid off. The senior unsecured bonds got a little bit of value, and everybody else just got wiped out in real life. If this is a cyclical or an operating problem, or even if it's a secular problem and management like Netflix is smart enough to figure out how to get out of the box and get EBITDA back to 290 million, then you really could, quintuple your money. If you bought this stock at $1 and it doesn't file, and that's critical for the stock, you could have a stock that's worth $5. That's a pretty nice return. But in the downside and base case, EBITDA doesn't climb again, it stays the same or it continues to decline, and so the company ends up filing. The bonds may recover par, they may recover zero, but the equity typically gets wiped out. So in real life, companies are rarely sold. What typically happens is they're restructured, given a lower value, and that new value is distributed to existing creditors in the form of new equity and new debt. So this is not the perfect analogy, but say you own a house and it's worth, $500,000, say you bought it for less, but you've got a $400,000 mortgage. Say you bought it for $450,000, but now it's worth $5,000. You've got mortgage of $400,000, and your equity, you're sitting on $100,000 worth of equity. If the value of that house, just like the value of the company, because multiples have come down, EBITDA has come down, etc., drops to $350,000, the mortgage holder is entitled to $350,000. They won't get paid out at $400,000, but whatever value it is in a scenario similar to bankruptcy, the mortgage holder gets whatever value, the debt holders get whatever value there is, and you as an equity holder would be wiped out. Typically, that house would be sold to someone else, and that new owner would finance that $350,000 purchase with a new mortgage and new equity. So, of course, in the case of a house, the old mortgage holder gets paid out. But with a company, the old mortgage holder would get $300,000 of new debt and $50,000 of new equity. So it's the best example I can give, but typically companies aren't sold. Typically what happens in a restructuring is that the existing debt holders are given new securities in a restructured company. And the fun of bankruptcy is the negotiation process. Needless to say, the valuation, there's always like issues. What is it really worth? It's a negotiation, and that is actually the fun and the part that goes into a bankruptcy or distress credit that you don't have in any other kind of investment. So the last thing is, what price should I pay for the bonds? What went wrong? Does management have time to fix it? What are the company's bonds and equity worth? So here's a situation where the company's distressed bonds offered at a price of 75. They have an 8% coupon. They mature in 4 years. Your liquidity analysis indicates that the company may run out of cash in a year or so, leading to a restructuring. And your valuation analysis indicates that the bonds could be worth 91 cents to par in a restructuring. What should you pay? This is a typical yield to maturity that you would do on Excel, but this is a yield to maturity. So the yield to maturity on these bonds is almost 17%, totally irrelevant because these bonds are not going to go to maturity. The company's going to file before then because you did your work on liquidity and go, God, these guys are going to run out of cash in 2 years. These bonds are never going to get to maturity. The company's going to restructure. So what would you pay for the bonds? So bonds are usually offered at a price. You don't have to buy them there. You may say, you know what, those are too expensive. I'm going to wait. In your worst case, and so what you would do is modify the cash flows to incorporate what you think the most likely scenario is. And that is you buy them at 75, you collect a coupon for 1 year, the company files bankruptcy, it goes into a 2-year restructuring. During that restructuring, you get no coupons. So that's a zero. And at the end of the time, you get 91 cents that is made up of new equity in new bonds. You do an IRR on that, that's a 10% IRR. In the best case scenario, you recover par, you do an IRR in Excel, that IRR is like 14%. That is not particularly interesting given the amount of risk that's involved in a bankruptcy. So that's what you would earn if you bought bonds at 75. What should you pay? Then instead of doing an IRR calculation, you do an NPV calculation. So let's say you want a 20% return. You use the NPV formula on Excel. You put in the cash flows, not what you're going to pay because you're trying to solve for what you're going to pay, but you want a 20% return. You're going to get a coupon. And in this case, what you've done is you said you get a coupon for 1 year. Same thing as the other one. You get an 8% coupon 1 year. The next year, they file bankruptcy at the end of that year. The next year, they're still in bankruptcy. You don't get any interest. But at the end of the second year of bankruptcy, you get your 91 cents. In that case, what this is telling you is if you want a 20% return, you don't pay 75 for the bonds, you pay 59 or 65 for the bonds, depending on whether you think it's a 61 cents, depending on whether you think it's a 91 cent recovery or a 100-cent recovery. Second to last slide. If the company restructures, the stock will be worthless. But in 2 years, if the company manages to increase, if you've listened to the conference calls and you're convinced that Cumulus can solve this, you listen to the conference calls and you're convinced that Tesla can fix its issues, General Electric can fix its issues, that Goodyear can fix its issues, that Cumulus can fix its issues, and the companies can avoid bankruptcy, and the stock, your analysis shows that the stock could be worth $7.35 in 2 years. We didn't take it out to 3 or 4 years because it's not a bankruptcy. And as an equity holder, you don't get any dividend, you don't get any interest payments anyway, and probably no dividends in a distressed situation. But you pay $2 for the stock. You don't collect anything in the first year. By the end of the second year, management has worked their magic. Elon Musk has gotten the thing running on all cylinders. Cumulus has hired the right DJs. People are not going to mobile anymore. They're going back to radio. The stock is worth $7 a share. You've almost tripled your money. Over a 3-year period, you've made a 92% IRR. So that's why distressed or beaten up stocks can be very interesting. But again, this scenario only holds up if the company doesn't file. If the company doesn't file, and I can talk about it in the Q&A, if the company files, almost always the equity is wiped out, because what people do is they take a very conservative approach to valuation and they base the restructuring on that. And so you almost never recover anything in a bankruptcy. But if you think the company can recover and you buy the stock at $2 and it's worth $7 in 2 years because EBITDA recovered, you got a home run. So just to recap, what went wrong? Can it be fixed? Does management have enough time to fix it? What are the company's bonds and equity worth? And what price should I pay for the stock of the bonds? And this is helpful even if you never do distressed investing, because it helps you to think about business risk. Read McGrath's book. It's excellent. It helps you think about valuation when you're buying stocks for yourself. Is this the right multiple? Is this earnings projection the right number? And it helps you think about risk and reward, which is why I really love distressed investing, because you really have to think deeply, not just about the valuation and cash flow, but about what happens. Can management fix this business? What debt is ahead of mine? What multiple should I use? As I said, I think it's the most fascinating form of credit investing. And I think, Adam, we have time for a few questions.
Great. Thank you so much, Shelly. That was quite Very good presentation. I know, as you mentioned, it's this tends to be a 4-hour broken up into 4 parts. So, yeah, exactly. So this was the accelerated version, and I know it's a lot to cover, but very interesting. And I just a quick note for those of you who are new to our programs. We will generally have, usually on a weekly basis, these types of sessions with either our teaching assistants, course leaders, or faculty members from our partner institutions. So this is sort of how this component of the synchronous aspect for our certificates looks like. So we do have around 10 minutes, and for the Q&A segment, if anyone does have questions, please use this chat box, and we'll try to get to them. Did have a few questions so far about both the slides and the replay, and I should have mentioned at the beginning, but we will send both the online video replay of this session along with the slides for anyone who is interested. So don't worry about that. And so, Shelly, while we're waiting to see if we do have a few questions, I have a couple. Just first of all, taking a couple high-level perspectives. One, when we say distressed investing, is there a specific definition of a distressed situation, or is it more you sort of know it when you see it?
Yeah, so for a distressed bond situation, typically if the bonds are trading, bonds are generally issued, and if they're healthy, they trade around par, around 100 cents on the dollar. Obviously, that is subject to interest rates, because if the bond is a 4% interest, coupon, and interest rates are now 6%, the bond's going to trade at a discount. But that's for interest rate purposes. For credit purposes, typically, like anything between par and 9, considered stress, not necessarily distress, but stress. Anything lower than 90, kind of really around 85 and lower, the bonds are trading at 60. If they're trading at 75, that's considered distressed. With stock, it's really off, how much it's off is high. So, GE is definitely, General Electric is definitely a distressed stock, even though people don't call it that. They call it a beaten up stock like that. Maybe a year and a half ago, General Electric was trading at $30 a share. I think with single digits, it's 8. So you'd be hard pressed not to think this is a problem here. People have concerns about the company and its longevity and its value. So with stocks, there's no rule of thumb. But, if it's way off its high, I would say it qualifies as a deep value distressed stock. And bonds, if it's trading under 90, under 85 cents on the dollar, then it's typically considered a distressed bond.
Okay, great. Thanks, Shelly. And is there a for folks who are interested there? Is there, in terms of identifying potential distressed opportunities, is there a quick way to find either bonds that are trading at that level of discount you mentioned, or stocks that are down a certain percentage? Obviously, you can, if people want to spend the time, they can do it. But is there kind of a one site or a shortcut that you could point people to?
Yeah, you can set up, like on even a Yahoo Finance, you can set up alerts that when a stock, or Seeking Alpha, when a stock trades low. And again, you'll capture also, what's going on now in the U.S. equity markets, where, stock prices are coming down. All of them are coming down. But you can set up alerts on Yahoo Finance or on Seeking Alpha to, get an alert if a stock price, the stock that you're interested in, drops 10%. But it kind of is specific. You kind of have to have something in mind. It's reading the headlines. It's reading the headlines, reading the Journal, reading the Financial Times, reading the New York Times, because you'll often get hints there, and it's setting up alerts. I think the alerts are usually tied to a specific stock, so you almost have to know first. So maybe you read a story and then you set up an alert. If you read a story about GE, a year ago, you could set up alert that, hey, if it, drops by 50%, I get an alert, and then I'm going to start paying attention to it then.
Okay, great. Thanks, Shelly. And I'm curious, obviously with Columbia, which is one of the founders of value investing with Graham and Dodd. Do you consider distress to be a form of value investing, or do you consider the approaches to be mutually exclusive?
No, I think distress is definitely a form of value investing because you have to take a deep dive. Like I buy stocks for myself sometimes, but I don't necessarily take a deep dive into value. I'm just like, oh, I think I'm making this up. I think Apple's earnings are going to be good. So I'm going to buy some, and if it pops up, then I'll sell it. Distress is much more a long view, not probably as long as, Warren Buffett, the view that he takes, but it's definitely a long view because a typical bankruptcy is 12 to 18 months. So again, you could have a situation where you buy GE stock or you bought, Cumulus bonds, and they'll pop up because they have a good quarter or some positive news comes out, but it's definitely a long view. And if you realize that you're going to be in an investment for a long period of time, you want to do a deep dive. So I think in that respect, value investing is very similar to distressed investing. It's all about the business. It's all about the valuation. It's not just, I'm going to buy this and I think it's going to pop up because earnings are good this quarter and I'm going to sell it. I'm in this for the long haul. And so in distress, you will get opportunities to exit a position because it'll pop up. So if I bought bonds at 60, I think they're worth 80, but if they pop up to 70, I might take some profits off the table. But I also know that this could be a situation where I'm in it, if the company gets into real trouble, I'm not going to be able to sell those bonds. They may drop from, 60, they may drop to 50 or even 40. Maybe I buy some more, maybe I just sit tight, but I'm in it for the long haul because I've done so much work that I'm comfortable that these bonds that I bought at 60 are worth 80 or 85. They're going to drop down to 40, but I don't care. Maybe I'll even buy some more. But distress is very similar to value investing in that way.
Mm-hmm. Great, thanks, Shelly. If I understood correctly, I think you suggested, at least the way you look at it, there tends to be sort of three buckets for distress situations. One is where you have a rising cost scenario. One is a pressure on the top line or the revenue, and then the third would be sort of management specific. Is that generally correct?
Well, the buckets are really, when companies in financial stress, it's usually something happened on the top line or something happened on the cost line. But if you look at, I'll try to go back to the slide, those cost and revenue issues can be divided into a number of things. So the top line issue could be industry specific or company specific. It could be cyclical or secular or operating. So it usually comes down to top line is eroding or costs are rising. And the reason behind that is either industry-wide or company-specific, cyclical, secular, or operating. Again, as I said, you have some one-off things where it's this huge, like P, E, and G, where, did they cause wildfires, billions of dollars of lawsuits, doesn't fit into this framework, but this is the typical framework.
Right. And so just to drill down there, just based on your experience or when you screen for distressed opportunities, is there one that you have done better in or you think are more interesting? In other words, do you find the more ones that are more pressure on the cost or on the revenue, or kind of what would you say is your sweet spot for something you think is really interesting?
I don't think I have a sweet spot. As we say in distress, you don't pick the industries pick you. So you look at whatever's going on at the time. What I would say is the cyclical ones are probably easier to digest. It's easier to analyze what went wrong and maybe get a handle on when it will end. The toughest ones are the secular ones. And what I will say is we see much more secular now because of technology. So I didn't discuss cable companies, and I don't think they're distressed, but you could see some distress in the future with cable and satellite. With live streaming, there is a whole generation that's doing what's called cord cutting or never a cord. So in other words, they're not signing up for cable. They're not signing up for satellite. They're strictly doing, Netflix. They're strictly doing Hulu. They're strictly doing Amazon Fire, etc. So you're seeing a lot of that now where technology is initiating secular changes. So recent bankruptcy was called Senvail. They make envelopes and they print stuff. So think about it. Envelopes, who's mailing stuff? anymore. And in addition to that, everybody pays their bills online. So not only do they not have an envelope coming to you every month for you to pay your credit card bill, but you're not sending anything back. And nobody's printing brochures. Companies, do they even print annual reports anymore? No, you say, go to my website. So that's a secular shift, and you've seen hundreds, thousands of small printers go under. Senveo was a bigger printer, and they went under. They no longer had a reason to exist. So those, I think, the cyclical ones are easier to understand, maybe easier to fix, easier to identify the problem. Secular ones are really hard. It's hard to figure out what went wrong. It's not always obvious, and it's really hard to value them because you don't know, like with Senveo, is EBITDA or cumulus? Is EBITDA going to stop at 200? Or is it going to keep going down? And people have seen that with newspapers, where circulation just continues to go down. I don't think my kids have ever picked up a newspaper. They get their news from some website or something like that. And so as a result, circulation for the New York Times, Wall Street Journal, USA Today have all come down. Now they're trying to offset that by establishing paywalls. So you get, if you pay a subscription online, you can get access to, additional content, etc. But I think the secular shifts are the hardest, both to identify, both to fix, and also to value.
Great, thanks, Shelly. That makes a lot of sense. Just two student ones here, and then we'll wrap up. Chris just wanted to clarify, when you mention buying debt or bonds, are you making reference to a portion of the debt that an individual can do, or the whole debt, which could be done by an institution?
Either. What I try to do, so as a hedge fund person, typically, unless you love the situation, you don't buy the whole capital structure. You will buy, if there's a $750 million issue of bonds and they're trading at 60 cents on a dollar, you don't usually go in and buy the whole $750 million issue. You might buy 20 million of bonds or something like that. You might start out buying a few, and then you add to your position, and the more you like it, maybe you end up owning 20 million, some percentage of the whole issue. With individuals, as I said in the beginning, it's very hard for us to buy bonds. Bonds usually trade in $1 million pieces. Even if sometimes you can pick up $50,000 worth of bonds, but even if they're trading at 50 cents on the dollar, you're paying $25,000 for them. That's a lot for an individual to sink into one single issue. So with bonds, it's really institutional. Even institutions don't tend to buy the whole entire issue. They tend to buy a portion of the debt that's outstanding.
Great. Thanks, Shelly. And one last one. We just had a question, hoping for just kind of a summary of the tools. And I think you had one slide about the 4 steps in the process, if I recall.
Yeah, so this one is a slide that I've repeated throughout, but what went wrong, can it be fixed? So your investment thesis, you should be able to say, like with Goodyear, their costs are rising, their revenues declining. I understand what went wrong is linked to oil prices. I think it's cyclical. So how long is it going to last? So second thing is, and can management do anything in the interim to kind of offset what's going on? Goodyear could, both on the cost side and the revenue side. Do they have enough time, can they survive until the cycle changes? So you do the analysis like we did with Tesla, and you go, okay, this is, I think these guys, they have enough cash, they have a revolver, a credit line that they can borrow on. Yes, they can survive. What are their bonds and their equity worth? So in Goodyear's case, I think they'll survive. They won't have to file bankruptcy. They have a lot of cash. So what I'm going to do is take what I think EBITDA is going to recover to once oil and gas prices come down and people start driving again. I'm going to apply a multiple to that based on where Michelin and the comps are trading. And so I think the equity is trading at $9, but I think the equity could be worth $20 because I don't think they're going to file bankruptcy. I think equity is going to come back up again after the cycle changes and oil and gas prices are going to come down. And so based on that, if I think the equity is going to eventually be worth $20, what should I pay for it now? And it's pretty easy to say $9 because you basically doubled your money in 2 years after the cycles change and Goodyear's EBITDA has come back up again. So those are the 4 steps pretty much for any distressed bond or any beaten up stock.
Great. Thanks, Shelly. It's a good place to end it. Shelly, thank you so much for your time today. Thanks, everyone, for spending part of your morning or afternoon or evening with us. And again, for those of you who like this format, who are new to FFI, these types of sessions are not the only part of our certificate programs with Columbia and Wharton and UNC, but are an important part, interactive part. We're able to take real world examples and apply them with great teaching and experienced folks like Shelly and the faculty at those institutions. And again, those programs are starting up next month. So if you're interested, we hope you can join us, or just follow our website and email us if we can be helpful. So thanks again, everybody. Thanks, Shelly. Take care.
Thank you.